Tonight, we look into the business of bank loans, and this is why.
Between 4 and 5 million Kenyans will, by beginning of November, they will be out of the blacklisting. That is very important. Very important because...
And we all like that announcement, going by the celebration and the clapping that immediately followed that directive. I mean, the only thing that was missed from that entire announcement is this version of twerking.
Okay,
So how do banks make money, you ask? In the simplest analogy, at the core, banks are considered lenders, meaning they make money by borrowing it from depositors and paying them back with a certain interest rate once they lend the money out to borrowers. Now, all this is governed by one concept: interest rates. Bank will love to lend at extremely high rates, but because they know customers will look elsewhere for alternatives, they will try not to be crazy, but at the same time, they do not have that much leeway in the pricing of interest rates because the regulator of the banking industry, in this case, the Central Bank of Kenya, has to approve the rates. So it makes you wonder what the Central Bank of Kenya governor from 1993 to April 2001 was smoking back in 1994 when the average lending rates rose from 21% in 1992 to a high of 32.2%. So it means that in 1994, if you borrowed 10 shillings from a bank, you had to pay back 3 shillings and 62 cents as interest, which was almost half of the principal amount. Honestly, this interest rate was akin to letting your wife choose the color of your car and expect it not to turn up pink. Walking to the bank to take a loan in 1992 wasn't for the weak. The only way you get lucky with the banks is if they turned into women and showed you zero interest. Get it? Yeah, women and showing no interest. But not to worry, because we have been assured by the man who the Kenya Commercial Bank Group struggled to find a replacement for that we are not going back to the 20 or 30% interest rates.
The regime of the 20% interest rate is long gone. The environment, the macroeconomic environment, the business environment where we are today does not at all support an element where those rates can be applied. So
now, this profits within this interest spread can be achieved by what the industry experts call the money multiplier theory. I know what I'm about to say will sound like this guy trying to work out numbers.
769, 800 and 700, listen properly, 769,820 and 70.
But hear me out. A depositor's money grows through a financial activity, for example, increased spending and investing. Now, the ratio between money earned as a result of the spending and the money and the amount spent is the namesake multiplier. In simpler terms, the bank will make its money through lending, investing, and fees for services. This therefore simply means that banks are critical to the performance of the economy if they do their core business of lending correctly, and that correctly is in quotes. This simply means that if properly inclusive economy, the performance of the financial services sector will be a clear indicator of the performance of the economy. Introduce former president, and in our case, President Uhuru Muigai Kenyatta, and the Central Bank of Governor Dr. Patrick Njoroge, the then custodians of our economy. Now, the governor and deputy governors are appointed by the president through a transparent and competitive process and with the approval of parliament. The governor and the deputy governors hold office for a term of 4 years, but are eligible for reappointment from one further term of 4 years. Okay, but wait. If the law clearly stated that Central Bank of Kenya should have 2 deputy governors, why is it that under President Uhuru Kenyatta's tenure, the Apex Bank never saw a second deputy governor? But maybe, as a president, when you have a man with this kind of lifestyle, you don't need a second deputy.
I mean, how could you possibly drive 5 motor cars at once? I mean, if you can't let me know. But I think you can only drive one at any one time. Why not stick to the to that one car, or when it is in service, you use another one, whatever. I mean, simple life. The big man sort of syndrome, which is the only way to show who I am is by flaunting all the possessions that I have. It's kind of dangerous.
To prove further that this guy can run the CBK by himself, during his vetting in 2015, they discovered he had no wife. That was not even the interesting part. It gets amazing to listen to what the committee thought of him after realizing that he had no wife.
I'm single by choice. It's not because there's a problem or whatever other, or shortage, I assume.
You see, a bank will only give you money if the credit officers tick the following boxes: your profit and cash flow, what security is available, what will the next loan be used for, your personal credit assets, enterprise finance guarantee, and lastly, for Kenya, the regulatory support framework, and in this case, the credit reference bureaus or CRBs. In other words, the bank is not your mother to give you free credit. For a long time, local banks have always viewed the MSME sector as a risky segment of the economy to lend to. So if any president was going to change how banks viewed the MSME sector, they had to come up with a comprehensive system and framework to collect data for the sector and to push the MSME sector to formalize, which will translate to available information for the banks to utilize to make lending decisions. But no, that would officially put the MSME sector on the radar of the Kenya Revenue Authority, who will come knocking for them to pay their taxes. In fact, Kenyans hate the Kenya Revenue Authority so much that if you walk to their offices today and ask them how many SMEs or MSMEs there are in Kenya, they would completely have no clue at all. And to make it worse, they do not know how to define an SME because they have no reliable data to allow them to authoritatively do so. Now, back in 2016, to try and solve the issue of lack of funding for the MSME sector, Kiambu legislator Jude Njomo sponsored a bill that was to cap interest rates so that the entire economy and largely businesses could get access to cheap credit. On paper, this was beautiful and well-intentioned, but no. We already said that banks are not your mother and you can't force them to lend.
You have to cajole them. It doesn't work if you try and force them. People will stop doing business and they'll go and look for opportunities elsewhere where they're not under this kind of intrusive regulatory framework.
Yes, but then again, even as the government was pushing to have cheap credit to the economy or available to the MSME sector, they were messing the same lending environment that they wanted to correct by being the biggest consumers of the available credit that was instead meant for the MSME sector. But even more than that is the fact that maybe there was more than a Jude Njomo saw to the bill other than the access to credit by the small businesses in the country.
The MPs are big borrowers from the banks and therefore they have a keen interest, as we all do.
Sneaky bastards. What followed was a cap on interest rates where banks outrightly freezing lending to the MSME sector and instead directing their funds to the government securities because as of 2017, credit growth in the private sector jumped an insignificant 2.7%. Jude Njomo came back.
I still feel, yes, we may have to remove the caps, but the time has not come.
No, sir, it doesn't work like that. They refused the problem with democracy. They refused. Now, the problem with democracy is that whether you like it or not, the likes of Babu Owino and Jaguar will at the end of the day sit in parliament and pass critical motions that govern the shape of the country, and the best way they know how to do that is through this. Had they listened to the technocrats, they would have already been known or been told that the conversation of interest rates started back in 2015 when the committee vetting Dr. Patrick Njoroge asked him to give his stance on legislating interest rates. This is what he said.
We have countries which regulate interest rates by legislation.
It would be a mistake, and a big mistake for that matter, to believe that we can control interest rate by
fiat or by law in a legislative way.
You see, what banks basically wanted was for them to control the pricing of the loans based on the perceived risk factor in the various sectors they were lending to, and that is why they will choose to lend to the government, whose appetite for the debt since 2013 has been continuously growing or competing with the local MSMEs for the available credit from the local banks. Now, to understand how heavily banks are lending to the government, Moody's assessment of the industry in 2020 found that the government bonds accounted for 37% of Kenyan banks' assets and warned that this sovereign exposure was likely to increase from these levels over the next 12 to 18 months, meaning that these numbers increased exponentially in 2021. So the government thought of a new product, Starby Loans or Enterprise Guarantee Fund. During the launch, the president blasted banks for sidelining the MSME sector and denying them credit.
Let us become realistic in how we do our things. When you say high risk, what is high risk? It is easier, it is better for you to find mechanisms and ways to lend to those young men and women who are interested in making something positive of their lives, who are interested in employing their fellow young men and women.
High risk and easier cannot be used in the same sentence. Completely no. It is like saying my 22-year-old girlfriend who lives in Kwetu hostels loves me and I never take her out every Friday. And if you forgot, banks are not your mother, so they do not want to lend to you and they will not. This guy was an economics student, for crying out loud. Now, the product was good on paper because MSMEs were to get up to 250,000 worth of credit payable on 9% interest for a period of up to 1 year, with the government guaranteeing a certain amount of the defaulted loans. Only 2 years down the line, the Business Daily ran a story with the headline, "Banks Abandon CBK's MSME Mobile Loans Deal." Say, we told you, your banks are not your mother. Now, the story went ahead to state that the lenders cited difficulties recovering the loans for their decisions because the small and medium enterprises were defaulting on the unsecured mobile-based loans. Since its launch, neither the Central Bank of Kenya, Dr. Patrick Njoroge, nor the president came out with a review of their brainchild. So now your president looked elsewhere for solution to unlock the lending to the MSME sector in the country, blacklisting. At the onset of the COVID-19 pandemic in 2020, former President Uhuru Kenyatta ordered a ban on blacklisting by the credit reference bureaus in the country for a period of 6 months because of the anticipated dip in the business activity in the economy. That was totally understandable because of the massive job losses and subdued world economy. Now, the banks were in total support of this directive and even agreed to restructure their loan book, with the MSMEs leading the pack with a 234.7 billion shillings worth of loans restructured, up from 20.6 billion shillings in 2019. Fast forward to 2021 on Mashujaa Day celebrations, where the economy had been fully reopened and the business is assuming normalcy, the president announced that again, for 1 more year, anyone with a loan totaling less than 5 million shillings dating back to October 2020 was not to be blacklisted. You see, before the advent of CRBs, the only source of credit information between banks was the bank's databases. Now, this is how it worked. If you walked into a bank to ask for a loan, the banks would ask if you had another bank account. And if you said yes, they will ask the other bank to give you a report of your credit history. If you had a poor report, the other bank would recommend you to the other bank as a good borrower so as to get done away with you. But if you had a good report, they would give you a negative recommendation so that they retain you. So what the president effectively did, other than kill the CRBs in the country, was to tell the banks not to lend to the MSME sector again. In a weird twist of events, the Central Bank of Kenya, Dr. Patrick Njoroge, indicated the following. Now, the suspension could adversely impact the provision of credit by banks in the target MSME group, as they will be unable to distinguish between the good and bad borrowers during the suspension period. This could lead to rationing of credit, as evident during the period of interest rate caps from 2016 to 2019. End quote. Oh yeah, like you didn't know that this was going to happen before your boss declared this. There is a similar script in the economy currently. Now, through President William Ruto, delist the hustlers and give them credit. On the other hand, there hasn't been any announcement on what banks should do.